Hi, Charles Sizemore here. Today, for our dividend stock of the week, we're going to focus on gold, and specifically, there is an inflation angle here. Inflation is still pretty muted right now. It is popping slightly as producer prices are significantly higher than they were a year ago. Of course, as due to the pandemic depressing prices a year ago, prices are more normal today. But the fear is that this is only the beginning, that we could see inflation really spike higher over the next several quarters or possibly the next several years. We'll know when we see it. It is too early to say, but we do know that the Fed has already injected several $1 trillion into the financial system. And they're not done. They continue to grow their balance sheet by about $120 billion a month. Every dollar that they inject into the system by buying bonds, by buying financial instruments, that really does kind of create that kindling that could make inflation possible down the road. Now, no one's really concerned about a single year of inflation. If it's a blip, it's a blip, no problem. What people worry about is trending inflation. That's a really big deal if you're an income investor, because if your income stream is relatively fixed from bond interest or from kind of slow growth but high yield dividend stocks, you actually get poorer every year. So imagine your retirement could easily last 20 years. If you retire in your late 60s, early 70s, or even mid 70s for that matter, if you live to be a ripe old age, you could be retired for multiple decades. So that is a big deal if you're losing purchasing power every year. You don't want your lifestyle, when you're 90 years old, you can't really go out and get a job, right? That's not realistic. You are at the mercy of whatever your investment and Social Security, whatnot, is paying. So you really want to make sure that, the nightmare scenario is you don't want to run out of money in old age and be forced to move in with your kids or be forced to accept government aid or something. That's not a dignified way to spend your later years. So staying ahead of inflation matters. Now, let's say you're losing 1% of your portfolio value per year to inflation. Let's say that your gains are undershooting inflation by about 1%. That's not hard to conceive if you have an income portfolio. Right now, even in this low inflation environment, most fixed income portfolios have negative real yields, meaning that, you're getting a positive nominal yield, but when you adjust for inflation, you're actually losing money. So let's say that that deficit is 1%. Inflation compounds just like interest does. So over 20 years of losing 1% to inflation a year, you're talking about a portfolio reduction of a little over 22%. So $1 today is going to be worth 78 cents 20 years from now in that scenario. That's a problem. If you need that dollar to live 20 years from now, you're going to have to learn how to live on less unless your income stream keeps pace with inflation and ideally surpasses it. So that brings us to gold. I'm not a gold bug by any stretch of the imagination. I'm not an ideological gold guy. There is a type. There is a type of investor that kind of views gold almost in religious terms. It's something they believe in. That's not me, and I would encourage you to be a little bit more level-headed than that. But gold does have a good track record of keeping pace with inflation. There are exceptions. If you want to get historical, 15th century Spain saw massive, gold didn't do so well because you had all the gold coming from the New World into Spain and then into the rest of Europe. That was actually very problematic. But these isolated incidences notwithstanding, gold has been a really good store of value. Again, it has its bull markets, it has its bear markets, but if your goal is to just stay ahead of inflation over time, gold's track record is good there. Now, that brings us to one of my favorite gold miners, Newmont Mining. Newmont Mining is large. They have over 90 million ounces of proven reserves. They're scattered around the globe, operations in North America, South America, even Africa. They're good. They're a blue chip in this space. The stock currently yields about 3.6%, which is very competitive in this environment. The S&P 500 doesn't even round up to 2 at this point. Yields are exceptionally low in the broad market. And even after the recent spike in bond yields are also still very, very low. So a 3.6% yield is nothing to sneeze at. Now, where this gets interesting is the dividend of a gold miner is, of course, tied to its profits, which is in turn tied to the price of the metal. When gold prices are rising or trending higher, the cost to produce that gold doesn't really change that much. So it's you can think of gold miners as sort of a leveraged play on the price of gold. It's when gold prices are trending higher, gold miners make out like bandits. When gold prices are trending lower, they do really struggle. So you do want to sort of time your purchase appropriately. If you believe, as I do, that gold is likely to either maintain its value or probably see pretty substantial increases in dollar terms, then owning a few gold miners isn't a bad option. Now, Newmont, again, because that dividend is ultimately tied to the price of gold, they actually had to cut their dividend back in 2013, 2014. The price of gold had been in the toilet for a while. It had come off several good years, but when that price craters, it really craters. And gold and commodities in general really didn't do very well in the decade of the 2010s. So Newmont actually had to slash its payout. However, it's been raising that payout every year since 2017. And in the last year alone, it's doubled it. They've more than doubled their dividend in just the past year because they're able to. They have the cash flow to support that. So you should only buy a gold miner as an income play if you, like me, believe that gold prices will trend higher or at least maintain their roughly current levels for the foreseeable future, for your time horizon of investment anyway. So let's dig into it. We always like to any stock we recommend here, we like to put through the prism of Adams' Green Zone rating system. It's a nice systematic way to objectively look at a stock and not get emotionally invested in it. I'm as guilty as anyone of liking a stock or disliking a stock based on reasons that can be pretty subjective. It's good to have a quantitative system that forces you into objectivity. If a stock does not rate well, then it's simply not one you buy. The numbers don't support it. Well, I'm very happy to say that Newmont rates well. It rates a 61 overall on Adams' model. That puts it into bullish territory. Anything over a 60 is bullish by our system here. And by Adams' historical work, any stock in bullish territory, stocks in general in bullish territory tend to outperform the market by about 2 times over the following 12 months. I think in the case of Newmont, that is a very realistic assumption. If value stocks in general, commodity-based stocks in general, income stocks in general, if these sectors continue to do well as they have year to date, I think the idea of them doubling the market return is not only realistic, but actually very likely and may in fact be conservative. So let's dig into the details here. Newmont rates highest, surprisingly, based on growth. That is very impressive given how difficult the last decade has been for miners. It really has not been a good environment, but Newmont manages to score a 94 in this space. Now, a lot of the points have come from the last couple of years. The stock has really had a fantastic operational run. They've really been minting money over the last couple of years, and that's showing up in the growth score. So that's great. I do expect that to continue. Quality is also a very strong category for Newmont. It rates a 91 based on quality. Quality is really important here too, because as I explained earlier, is really feast or famine for miners. When metal prices are doing well, the stocks do well. They make money hand over fist. But when metal prices collapse or trend lower, your cost structure doesn't really change that much. You still have people to pay. You have machinery to pay for. You have perhaps land to pay for if you don't already own it. taxes to pay, possibly government officials to bribe. I mean, who knows? But your expenses don't really change that much. So cost control is extremely important. Keeping your operation lean is extremely important, and keeping your debt manageable is extremely important. So the fact that Newmont rates very high based on quality is good. It makes me comfortable owning it in the event that I'm early to this. Let's say, metal prices don't just trade higher from here. They fall first, or this bull market takes longer to get going, or it doesn't happen at all. In that case, I'm willing to give Newmont a little bit of a longer leash to run because I know it to be a high quality company, a company that's able to navigate even difficult scenarios for mining companies. So moving on, we discussed that Newmont rates well on growth. It also rates really well on value, and that's relatively rare. Normally, growth stocks are not cheap. You pay up for growth stocks. I mean, that's how that works, right? But this stock does rate well on value. It rates an 84. That's good. Now, there is a degree of backward-looking bias here because valuation metrics are historical. You compare prices to historical earnings, sales, book value, whatnot. They don't really look ahead. All of those historical numbers are somewhat depressed for Newmont because the last several years have been difficult. But yeah, I do expect that to accelerate. Newmont may not look so cheap a year from now. I don't know, but that's okay. We're getting in at a good price today. And as I said a minute ago, if value stocks continue to do well, if commodity-based stocks continue to do well this year, I would expect Newmont to do well as well. It's off to a bit of a slow start this year. I do expect that to reverse in really no time at all. Volatility, the stock rate's pretty middle of the pack at 58. That's certainly better than half. That is pretty remarkable though when you consider the line of business that Newmont is in. Commodities are volatile. They are. It is what it is. Gold prices fluctuate. Lead, nickel, industrial metal prices fluctuate. They're all over the map. So the fact that Newmont is able to have a volatility score even in the top half is actually pretty impressive. I consider that a really strong commentary on Newmont's management. Now, the last two metrics don't really rate as well. Momentum, it rates a 3. I was a little surprised it rated that low, but as I mentioned, it has been a rough several years. Now, the last handful of years, the stock did show some signs of life. It has since given back some of those gains this year, and I think that's really what has hurt the momentum score more than anything. Is the performance has been really lagging the market over the last several months here. So if you are, let me back up for a second. You're not really catching a falling knife if you buy it today because prices bottomed out in February. They've been trading more or less sideways since then. But if you're the cautious sort and you really want to wait for an uptrend to be in place before you buy, that's completely understandable. You may want to give this stock a little bit more time before you jump into it. I would be comfortable entering at current prices and current conditions. But again, if you do want to be abundantly cautious, there's nothing wrong with waiting, giving this stock a few weeks before jumping in. And then finally, we get to size. This is a large company, a $40 billion market cap. So it's not surprising that it does rate low here. It rates a 1 out of 100. So we're not going to get much of a small cap bounce from this one, clearly. But overall, if you believe kind of the basic thesis I'm laying out here, that we may get inflation in the coming years. We don't know. Again, we're in uncharted territory. But if you think that it makes sense to have a little inflation insurance and get paid while you're doing it, then something like Newmont makes sense. It pays a great dividend, 3.6%. It's been aggressively raising that dividend lately. So long as gold prices remain relatively stable, I see no reason why it can't continue doing that. And, again, it does give us a little bit of that inflation insurance. In case inflation does start to trend higher, gold miners should really do well in that environment. So that's going to wrap it up for this week. So we'll catch us again, same time next week.